Applebee's house sirloin, please.
The #1 reason you belong at Applebee's.
It was America's favorite grill and bar, the biggest full-service restaurant chain in the U.S. At its peak, nearly 1,900 restaurants and about $5 billion in sales. That was Applebee's for much of the 2000s. Wall Street once loved its parent company, Dine Brands.
Applebee's and IHOP are both the #1 brands in their respective categories. Plus, remember, the results were real good.
But since its peak around a decade ago, the brand has struggled to grow its sales and store count. U.S. sales are down around $600 million, and the brand has closed more than 350 locations.
Applebee's is closing a few restaurants a year, right? And we're working hard to get that number positive. So at this point in time, investors are focusing on what they believe is the weaker link in the chain.
You would think that if you're contracting your footprint, that some of those sales would find their way into another Applebee's, but the sales are going elsewhere.
Olive Garden, Texas Roadhouse, and more recently its biggest competitor Chili's, have all surpassed Applebee's in terms of overall sales. The share price of Chili's parent company, Brinker International, is up around 150% over the past year, while Dine Brands is down around 40%.
So why isn't Applebee's seeing the same success as Chili's? And what's the company doing to turn things around?
Applebee's first opened its doors in 1980 under the name TJ Applebee's RX for edibles and elixirs in Decatur, Georgia. The business was sold a few times over the next couple of years and began franchising under the name Applebee's Neighborhood Grill and Bar. It grew rapidly in the US, jumping from 100 restaurants in 1989 to over 1,500 locations by 2003. By then, it was the biggest sit-down restaurant chain in the US.
Eating good in the neighborhood.
IHOP acquired Applebee's in 2007, forming the company that is today known as Dine Brands. Its share price peaked in 2015, but since then it's been a bumpy ride for Dine stock. The company spent $75 million implementing wood-fire grills, but the hand-cut steaks made in them were too expensive for its value-oriented consumer. It sent the stock price tumbling in 2016 and 2017. The announcement of a new CEO and the introduction of dollar margaritas helped rebound the stock, but ultimately the pandemic sent it crashing again. And despite an initial post-pandemic rebound, Dine stock has been on a years-long decline.
There's just nothing exciting to grasp onto unless you can show that you can develop. And unfortunately, Dine has been shrinking for a number of years.
We are crazy undervalued, in our opinion. When you look at the fundamentals of the company, the cash flow that we generate year in and year out, the stock at the moment is not anticipating what we think are the fundamentals of the company and the potential for growth.
Dine Brands' recent struggles with Applebee's have really centered on its inability to grow sales at its existing restaurants. Applebee's has seen declines for 8 consecutive quarters.
If I were to poll the investors in terms of what's important to the stock, I would say Applebee's same-store sales, for whatever reason, kind of punches above its weight. And it might just have to do with, okay, well, we can kind of benchmark it against Chili's, we can benchmark it against Darden. IHOP actually is the bigger profit contributor, largely because they own some real estate.
Just last year, 2 Applebee's franchisees filed for bankruptcy within weeks of each other.
It's a warning sign, but it isn't anything I think is going to be a material problem in the next year or two. You have to get the core customer back. Once you kind of fall out, it's very difficult to turn around unless you get somebody that is super skilled that's able to do it. But even then, your brand is kind of faded.
In January 2025, the company laid off 9% of its corporate workforce. Dine Brands blames sluggish 2024 sales on macroeconomic pressure. But that hasn't hurt its biggest competitor, Chili's, whose same-store sales increased by double-digit percentages over the past 4 quarters.
Our main competitor had a fantastic 2024, and we congratulate them for that. It's been a horse race between us and Chili's for years. And at any given time in a horse race, one horse's nose is ahead of the other. And so we've got to run a little bit faster in 2025, and we're doing a lot of work to get there.
Doherty Enterprises operates 80 locations across New Jersey and New York, including the location right behind me, which is the world's largest Applebee's right here in Times Square.
My father, Ed, he went into business for himself in 1985. He heard of this little concept called Applebee's back in the early 90s. I was there on day one working as a busboy and a host and a server eventually, and grew with the business and have been part of Applebee's for virtually all of my adult life.
Applebee's is almost entirely franchised, but just 30 operators control 1,450 locations across the US. For comparison, Dine Brand's other chain, IHOP, has 235 operators for its about 1,700 locations. Being almost entirely franchised makes its parent company, Dine Brands, an asset-light business.
Investors tend to like asset-light businesses. You know, you're guaranteed a certain range of earnings, even if same-store sales move plus or minus in one direction. So that's why the asset-light model works for a public company. But in terms of Dine Brands, it just doesn't have a lot of attention because there aren't many franchised full-service businesses to compare it to.
Only 8% of Chili's US restaurants are franchised. This business model made it a lot easier for the chain to pull off a major comeback last year. Decisions that are made at the corporate level can be executed more quickly. System-wide changes at Applebee's requires buy-in from its franchisees.
If Dine Brands went to their franchisees and said, hey, we want you to, increase your head count by 10%, franchisees might, have something to say about that. And there's multiple stakeholders at the table.
As fast food has become increasingly expensive, both Chili's and Applebee's have focused on deals.
This Chili's 3 for me is the best $10.99 you can eat.
$9.99. Applebee's really big meal deal.
But the difference in their success comes down to the level of investment made into the restaurants, not just the price of its food.
Chili's didn't just decide to put a burger for $10.99 on the menu and then see a 30% surge in sales, 20% surge in traffic. They spent $65 million in labor. They simplified the menu. They went viral because people pull like we did the cheese pulls on TikTok. They had a great experience and they came back.
Insight into the financials of what Applebee's has done to improve its operations is more tricky. Applebee's does not break out the expenses of its individual franchisees.
And the franchisee model is great as far as financial engineering, but the downside to that is you don't have operational control. So a franchisee could pretty much do whatever they want as long as they pay their franchise fees.
They have contractual obligations to do that within their franchise agreements, but they don't always enforce them. So we saw this at Burger King for years. They didn't enforce the remodel contracts. And so now we have a system that is in dramatic need of a makeover.
The company is doing some things to take back some control and improve operations. Dine Brands is offering financial incentives to early adopters of its remodeling program. It expects all of its Applebee's to be remodeled within the next 3 years. At the end of 2024, Dine Brands also took back the ownership of 47 franchised locations.
When it comes to renovations, I think the best thing we can do is demonstrate that a refreshed restaurant makes more money. And so that's why we're renovating 30 ourselves this year, so we can show to the franchisees, we spent this much money to renovate it, and here's the lift we got.
I don't think the brand should have to force the franchisee to do something. If they have to do that, then there's something wrong in that relationship. We do have 80 restaurants. Many of them are decades old, and it is time to reinvest in these restaurants.
Ultimately, Applebee's needs to prove its value to the consumer, not just through the cost of its food, but through consistently good experiences at its restaurants.
What's really important is the repeat business. So the same customers come back on a regularly scheduled basis. That's the primary thing they need to do. And then they also need to emphasize carryout. Because what carryout does is you take an existing space and you're running more volume through it.
Another way Applebee's is looking to drive volume and grow its locations is by opening combination restaurants with IHOP. Dine says it will open 14 in the US this year and has dozens more in development. The first US location opened in Seguin, Texas in February 2025.
It was a $2 million a year in sales IHOP, and it's now running at a rate of $6 million a year, adding an Applebee's. And so that franchisee alone, based upon those results, committed to opening 8 more.
Years ago, Yum Brands tried doing this with KFC and Taco Bell. Darden tried it with Olive Garden and Red Lobster. Neither worked. But Dine Brands says its model is fundamentally different because its brands are not competing with each other. IHOP is mainly serving a morning crowd, and Applebee's is mainly serving an evening crowd.
I don't think unit growth is all of a sudden going to ramp up to 5% because they're doing these combined units. But yeah, is there an opportunity in some markets where it makes sense? Absolutely.
Another way the company is incentivizing growth is by making it less expensive for franchisees to build new restaurants.
We've taken about $1 million out of the cost of building a new Applebee's, primarily in the kitchen, in the back of house. We found less expensive ways to do things than we were doing 30 years ago when many of the buildings were built.
Despite closing about 165 restaurants since 2019, Applebee's is still generating the same level of sales. Of course, much of that has to do with price increases of about 40% since the pandemic, which was in line with its competitors. However, investors are looking for system-wide growth, both in overall sales and the number of locations.
The restaurant industry is challenging. Traffic was softer than we would like it to be in 2024. That being said, I'm very excited about where the future holds us. I truly believe in the brand, and I truly believe that we will figure it out and be successful long term.